for those who don't know, you have there's a government agency in the United States. Canada has one as well for each province. The province is just the Canada equivalent of states, and then for the UK they have one as well. And for anyone, usually any developed country, every country pretty much, you have a government agency that's responsible for protecting investors from private investments. So you have public companies, like you can buy Apple, and then you have private companies that are not listed publicly. People confuse another thing of saying, hey, do I have to register with the SEC? What's registering with the SEC? Do I have to register with the SEC? So there's a lot of confusion out there. I'll start from the US and then go from there, but usually the SEC is responsible for regulating investments. And if your investment isn't registered with the SEC, if you're not trading a public investment or a public company, then you have a private company. And then you're exempt. And if you're exempt from registration requirements, that means that if you don't need to register to be able to sell your deal, then you have to follow the exemptions. You can't just do whatever you want. There are certain rules that apply to you if your deal is not registered. And these rules are called exemptions in many cases. So speak to a lawyer. I'm not a lawyer, disclaimer, but from informational purposes. Okay, so it's very important to know that if you're raising money, you're doing it privately, you follow the exemptions, the rules that allow you to do things without registering. One of the exemptions, the most common one, is called something called the Regulation D 506C. All that means is you're allowed to raise money from accredited investors, in a nutshell. An accredited investor is an investor in general that makes a certain amount of money per year, over $200,000 individually, or they make over $300,000 including their spouse, or they have over $1 million in net worth outside of their primary residence, or they have over $5 million in net worth with a spouse. So it depends on the location and so on, and there are different definitions. For example, if somebody's like, in many cases, somebody who's an investment banker or so on, or very knowledgeable about securities, knowledgeable about raising money, they can be an accredited investor even if they don't reach that threshold. But in general, these are the thresholds, generally speaking, in many cases for accredited investments. So, and then you have things that are above that. You have something called a qualified purchaser, etc. It goes up from there. There are different levels to this. But all in all, you want to make sure that you're talking to people that are accredited investors. So that's the first step. And then that allows people to use that exemption. So that means that if you were the one who's raising money for your deal and you're not brokering deals, because another thing is that if you're a broker, if you're brokering many deals and getting an equity commission in exchange for brokering deals within the United States especially, there are a lot of issues with that. Unless you're protected by a law firm or etc. There are a lot of issues with that. So you can't just do things like that. So there are a lot of rules when it comes to this space. You have to be very careful because you can get this serious trouble. The SEC can come after you, could be a federal crime. So it's a very serious thing where you have to exercise a lot of maturity in this type of business. That being said, speak to a lawyer. That's why I would say speak to a lawyer. But in general, for me, for informational purpose, because I'm not a lawyer, just go talk to a lawyer and they can walk through the details. But for informational purpose, what I'll tell you is it's really just a matter of going and making sure that you're following the rules, not brokering deals where you're not supposed to. And then if you're the principal or you work at one company and then you're the principal at your company, in general, it seems to be fine to just do that. That can allow you to raise money. Because if you're somebody who's a CEO of a company and you're raising money using the rules by getting a lawyer to review your stuff, raising money that way, that seems fine. But if you're somebody who wants to make money from helping people raise equity in exchange for equity commission by selling the deals yourself to equity investors, then that's a bit more dangerous, or you have to have some sophistication or structure around how you do it. In any event, that's that second step. And then the step after that is how can we go to the next level in the sense of what are the things that are needed for that Regulation D 506C. So usually you need something called a private placement memorandum. This is a document that explains everything about the investment, the risks, the benefits, and everything. Then you may need something called a subscription agreement. Very important. This is the document that investors sign when they're looking to invest into the actual deal. Some people have them combined, some people don't. Some people have another document called the term sheet, which is a summary of the list of terms. This may also be in a private placement memorandum. And the thing about all these documents is that they're very standard. A subscription agreement usually looks very standard. And if an investor sees a subscription agreement that looks odd and they're the experienced investors, they'll run away. The PPM, they have standard things in the PPM. For example, you have something called a jurisdictional legend. What's that? It talks about something called the blue sky laws. What's that? The blue sky laws are a set of statewide laws that basically mean, like, they define things that you can do in each state. For example, if an investor is investing from a certain state in America, the blue sky laws will determine if you have to notify the states and what disclaimers you have to have on your PPM in that state. Basically, some states want you to notify them before you accept money from investors or start raising money in that state, because you have statewide laws. Those are the blue sky laws. And you have certain risks that you have to disclose to the investors. Basically, the investor has to know that, know what risks, and there has to be a certain way that they word it. So you have to brainstorm with a lawyer different risks that apply and put them in your PPM. And then there's a part where you talk about your business model, what you're going to do, etc. Very important. So these are the things that you have to do when you're working on preparing to raise money. Now, you have operate agreements as well. So that kind of falls into the incorporation documents, but it's really more specialized in the sense of helping people raise money and the things that are needed for that. Because the operation documents, or what do we call them? Operating documents, that's really important to show investors and people how the fund actually operates. So those are the documents that are in general are needed. You have another thing is you have an accredited investor questionnaire, which confirms like, hey, this person is saying that they're accredited. Why are they saying that? Because if you take somebody that's not accredited, that's a problem. And in general, there can be more documents, there can be less, but in general, that usually is the picture. Sometimes you have something called a side letter, which is a custom set of terms for a specific type of investor. So that's the legal side in a nutshell.